Is JP Morgan's popular equity income ETF known as JEPI nothing more than a dividend trap? A dividend trap is a situation where a stock or ETF's yield might appear high and attractive, but could actually be quite unsustainable for a multitude of reasons. Investors might be attracted to this high dividend yield and overlook factors such as declining earnings, declining share price, high debt levels, or lack of growth prospects, to name a few. All meaning that over time, even though the yield might be high now, the company could see a sustainable dividend cut in the future. In other words, these dividend traps occur when a company's dividend yield looks too good to be true, and it turns out the company is actually struggling financially. Or in this case, we're talking about an ETF. Many high-yielding stocks or ETFs can lure in new investors with the promise of high dividend payouts time and time again, but only to find themselves experiencing significant losses later down the line, such as dividend cuts or lack of total return from the stock or dividend in the future. But what's very important to note is that not all high dividend stocks or ETFs are considered dividend traps, in that the dividend yield should not be the only factor investors consider when evaluating a potential stock or ETF to invest into. When I first got involved in dividend investing, the first thing I would do was sort everything by the highest yield to the lowest yield. Because after all, I was new to the entire idea of dividend investing. But over time, I was quick to realize that high yield does not necessarily mean the stock or ETF is a good investment. But let's go through JP Morgan's JEPI and talk about if or if not it is a dividend trap, or if it has more to offer. So JP Morgan's JEPI currently offers around $6.42 payouts, and that's annually. JEPI does pay out every single month, and the current yield is sitting at right around 11.5% or so. Now JEPI does pay out a different amount depending on the month, and if you look at the dividend history, things are moving towards the right direction as far as higher and higher payouts on average month over month. Now, one of the ways you can paint the entire picture of how a stock or dividend have performed over time is if you look at the total return compared to the total return of the S&P 500. If you look at JEPI's total return, which includes dividends, for example, versus the S&P 500, the S&P 500 returned over the last 5 years 65.55%. JEPI has returned 41.63% over the last 5 years. Now, one thing to note is that JEPI is a relatively new fund that has only been around since around 2020. So with that being said, that could cause a red flag right there. A lot of investors like historical data to look back on. And although whatever happens in the past doesn't necessarily mean it's going to happen in the future, it does make investors sleep better at night, knowing that they have a track record to go off of. But looking at JEPI's total return versus the S&P 500 over the last 5 years, JEPI's returned 41.63%, which is a pretty good return considering a lot of high-yielding instruments normally don't have that great of a total return. For example, if you add Q yield into the mix, which I do right here, Q yield is in the purple or the pink. Q yield's total return is 21.27% over the last 5 years. And Q yield is once again a very high-yielding ETF. So although JEPI does pay an extraordinarily high yield every single month, I would personally consider it not being a dividend trap, because after all, it does have a total return somewhere close to what the S&P 500 has also returned in the last 5 years or so.